Welcome back to Switzer on Sky News Money. Now, Westpac surprised some, opting for a $3.5 billion capital placement and even surprised more by raising interest rates. But all up, what is the view on the bank? And should you take up your right to the shares at $25.50? Paul Rickard is the former CEO of CommSec and he knows his way around bank balance sheets. So let's get him to rate Westpac as a buy or a sell right now. Paul, how you going?
Good, thanks, Peter.
Let's go through the story first. Were you surprised that Westpac would come out with a capital placement at all?
Look, I wasn't, given that the other three major banks had gone down exactly the same route. I was a little surprised the market wasn't perhaps giving it a little more focus.
Because some people didn't think they were going to do it.
Yeah, I think up to about 2 or 3 weeks ago, the market had probably accepted the sort of wisdom that Westpac could raise enough capital to satisfy APRA. And APRA, of course, is introducing these higher risk weights for mortgages, and Westpac could actually meet the target simply by having its next dividend reinvestment plan underwritten. It had 2 more to do before the 1st of July next year, and would sort of sail through the capital it needed. But I guess APRA is a pretty powerful regulator. When 3 out of 4 banks have done something, it's probably pretty hard to sit back there and just resist that sort of pressure.
So you reckon someone from APRA would have ducked over to Brian Hartson and said, look, come on, the other guys have done it, what about you?
Look, I wouldn't quite go that far, Peter, but I think the regulator, is pretty capable of making the right noise. And look, it gives them certainty. One of the advantages of doing the capital raising is you don't have to worry about having dividend reinvestment plans underwritten. It gets the situation, Westpac's positioned right now rather than 6 or 7 months' time. Lots of reasons why to do it. So I think that they probably just eventually followed suit. I'm
a bit conflicted because it makes my investments in all the banks, APRA's efforts, makes a much safer conveyance. So if
good for depositors.
Yeah, well, forget them for the moment. Even though one of my viewers are depositors. Sorry, depositors. But the bottom line is, if I'm investing in a better company, safer company, as a long-term investor, that's a good thing. But I am copping a lower share price because of APRA's overzealousness to make these banks safer, aren't I?
Yeah, well, potentially a lower share price, although that's one of the reasons the banks have come down. But going forward, of course, if the banks have more capital, they're going to have about the same amount of earnings. So the amount of earnings on a sort of a per-share basis decreases, and potentially, dividends on a per-share base, look, they may not decrease, but it'll be hard for them to increase. So the argument is sort of from a shareholder's point of view about having more capital, of course, is that return on equity will probably fall. And so that's what makes banks a little bit less attractive to hold. It's one of the reasons that over the last sort of 7 or 8 months, look, that sector as a whole has been a bit of a drag on the market. It wasn't that long ago we were sort of almost thinking about Commonwealth Bank was getting close to $100.
Yep, the $100 mark.
Back at $76, and we had Westpac touch $40. And this entitlement offer is at $25.50. So that's a big retreat. From the high of February this year.
OK, so were you surprised that they put an interest rate rise on both home loans and investor home loans?
I describe that as a courageous move on behalf of CEO Brian Hartson.
Yeah, and the Treasury, Scott Morrison, got stuck at him, didn't he?
He did, and they copped a lot of flack, and some of the headlines in the Murdoch press in particular where
Hey, I wrote one of those stories and used you as a quote.
Pretty exciting. But look, to be honest, I think he deserves, from a shareholder's point of view, this is going to cost, raising more capital is good for investors, but of course there's a cost. So who bears that cost? Should it be just shareholders? Should it potentially be some of the borrowers? And there's an argument why any home loan borrower should pay a little bit more for their mortgage. And maybe depositors need to fill a bit. So the argument, I think, is not that he increased them by about 20 basis points. The question was that a bit too much? Maybe in the long term it's not, but in the short term it possibly is. So, look, I think shareholders by and large should be happy with that. But you can understand why being first, you're in a crowd, you stand out, you take the hard step. You get the caning in Canberra and you get the caning in some of the tabloids.
Well, you know what his rivals are like after working for CommBank for a long time. Do you think they're going to rush to raise their rates?
I think they'll just stay mum for a little bit.
Let Brian take the heat, eh?
To his credit, the interest rate increase doesn't come into effect till the 20th of November. Now, the reason it's the 20th of November is that's when the entitlement offer finishes.
Okay.
So the other banks have got a long time to make up their mind, and I guess that they'll watch and wait and look, they'll stay quiet a little bit. But over time, look, those rates will come back together. So you can consider that at some stage the other banks will follow suit.
Okay, let's go to the institutional reaction to this. Been pretty good, hasn't it?
It has. It's been really good. In fact, there are three parts to the offer. The first part was completed last Thursday and Friday. And that's essentially the institutions saying how much they'll take up and any amount that they don't...
They like $25.50, do they?
Well, any amount that they can't take up or not prepared to take, effectively being auctioned amongst themselves. Now, the institutions decided to take up 95% of the amount they could. And some can't for various reasons. There's some issues around, residency of some of the institutions. The other 5%, Peter, was auctioned. It went at a price of $30. Now, that compared to a closing price on when the offer closed at $30.44. And given that there's a dilution because they're raising more capital, the new shares don't take part in the last 94 cents dividend. The actual theoretical price of a Westpac share was $29.33. So the institutions actually paid more than the theoretical, what we call ex-rights price. So that's one of the reasons why today, Westpac's up 90 cents, almost 3%, because the market said this is pretty good.
Yeah.
And the other bit that probably didn't get a lot of attention was Westpac actually brought forward its second half profit result, and that was actually pretty strong and much better than the analysts had expected. In fact, people like me had expected.
Okay. So we'll come back in a second. So I guess the bottom line is a lot of my viewers were saying, hang on, now when CommBank did this, the share price actually fell down pretty close to what the...
I think it dipped
below
about half a day below it.
That's right. But there were market meltdown issues and stuff like that going on. So do you think it might be unwise for people to expect that we'll see the Westpac share price go down to $25, $26 in the absence of a market meltdown?
I don't think that's going to happen because now that price is more than 15% below the current price. And the absence of market meltdown is not going to happen. Remember, this is the last of the four banks. This basically brings to an end sort of these big capital raisings. Look,
it's such an emotional ending.
It is an emotional ending. I mean, together the four banks through direct issues like this will have raised about $15.8 billion. And so it covers off all the question marks around the mortgage risk weights. I think we're not going to see 25, 50 bar a market collapse. And this is going to be really strongly supported.
Okay. Before I ask you whether this is a good deal or not, whether you should go ahead with accept the rights issue, what is the yield of a Westpac share now?
Okay, so based on its closing price tonight of $31.34, Westpac's currently paying a dividend of 187 cents. So that's yielding just a fraction under 6%, 5.97%.
We'll call it 6% amongst friends. Okay.
Now, on the yield on these new shares, now they won't take part of the next dividend. But they will after that. But let's just put that to one side. They're yielding 7.33%.
And we're leaving out franking credits and stuff like that. All right, so
that's over 10% on a gross basis.
So really, even if a GFC Mark II comes along in a couple of years' time, if you buy those shares at that price, you're on 7.33% forever, unless the Westpac cuts the dividend aggressively. And historically, they haven't been. You might go for 1 year at the most. The 7.33% is not bad, is it?
It's not bad. I mean, you come back to your point, yes, they could cut the dividend, but the record says they haven't. In fact, look at Commonwealth Bank since it was listed in 1991. Over the last 20...
Did you get shares in 1991? Yeah, no wonder you know this one. Go on.
There's only been one period they cut the dividend, and that was during the heights of the GFC.
So was it only 1 6 months?
Only 1.5 years. So yes, a dividend can be cut, but they've only done it once in 26 years, and every other period's been increased. So Westpac's pretty much in the same territory. So look, go back to take Westpac back a bit further. It had some problems as a bank in 91, 92, which is 24 years ago.
Bob Joss time.
Yeah, so these things do happen. But look, I think you've got a pretty high degree of confidence that that dividend can be maintained in the short to medium term.
Okay, so I guess you got a thumbs up on Westpac.
Well, I do. I mean, you've got three choices as a shareholder. And you get one new share for every 23 you have. Now, the maths on that's a bit interesting, but it means if you've got 1,000 shares, right, which is, some people out there would have 1,000 Westpac shares, you're going to get 44 new shares, or have entitlement to buy 44 new shares at $25.50, and that'll cost you $1,100 I think $1,122. I think I worked that out.
Yeah.
You've got three choices. First of all, you can sell the entitlement. So those rights are trading today on the ASX under code WBCR, and you've got until the 5th of November, I think it is. You can just, if you don't want to take them up, don't have the cash potentially, you can sell the entitlement.
Yep.
Second entitlement is take them up, which is what I'll be doing.
Yeah, me too.
And the third entitlement is to do nothing. Look, that's probably not the smartest move. If you do the nothing option, Westpac actually auctions those to other people, and maybe this time it'll work out, but you won't get the money till at the end of the proceeds.
Okay, running out of time, mate, but last week you reckon there was a few interesting super hints coming from Canberra.
Yeah, look, two questions in superannuation last week in Parliament. One was to the Prime Minister, one was to the Treasurer. The Prime Minister sort of essentially changed tack a little bit. Previously, up till the change of Prime Minister, the government have been saying no changes to superannuation, not even on the agenda. We're not going to have an inquiry into income streams, blah, blah, blah. Last week, certainly the change in statement was, yes, we're prepared potentially to consider some things, but it will be, any changes will be made as part of our election promise of 2016.
That's promising.
So that means changes potentially are back on the agenda. That's what I take out of that.
Yeah.
That was also complemented by an answer from the Treasurer, who basically said, look, we're not probably going to play around with the retirement phase, but didn't rule out some changes around what we call the accumulation phase. So I think, you've got to expect there are going to be changes. Maybe they'll go to an election first, but superannuation changes are sort of back on the agenda again.
And if someone could be a candidate for a transition to retirement pension, would you do it before any changes come along?
Look, I would. I mean, a transition to retirement for most people, 56 and over, we say pretty well is a no-brainer. There are a couple of reasons why you shouldn't do it.
Yeah.
But, you and I look at that. We look at how we advise our clients.
A gimme.
Yeah. It's had a good reason as to why it was established, but you'd have to say if you're in that age group, you should be thinking pretty hard about getting one, taking one out.
I always think 0% tax is better than 15.
It's a much better outcome. Better.
All right, mate. Good to see you. That's Paul Rickard. Apart from being the former boss of ComSec, he's also a star writer on the Switzer Super Report, particularly on banks. After the break, we'll find out if you've got enough money in your super fund to retire comfortably.